Hey everybody, Marty Mazzora here, after hours on Thursday, the 27th of July, 2023, with your week end, or I should say end of week, stock market snapshot. Clients, this will come to you linked to an email in the morning for Friday's morning message. Then we're going to get on our weekly economic update. I'll probably have that report to you later in the day tomorrow. If not, it'll probably be sometime on Sunday when I get it to you. So for this presentation, I am just going to touch briefly on what have been pretty boring technical charts, boring in a sense that it's just the same setup that I've been talking about now for some time. We'll look at just the daily on the S&P. I do want to spend a little more time on the NASDAQ chart, or the QQQ chart, which is the next one, because it's cleaner than this one. It's not as noisy. And I want to talk about where a real bearish setup in the spring didn't play out, and talk about why maybe that didn't play out. Then we're going to spend a minute on the dollar, and I want to segue to interest rates, gold, and so forth. And I want to talk about a conversation that we've been having a lot internally. And it just kind of has to do with the go-forward setup. As regular viewers and clients well know, we are cautious right here. I hesitate to say bearish or we're predicting a big fall or anything like that, but the underlying fundamentals are concerning in a number of areas. Our recession indicator continues to say that recession odds outweigh continued expansion odds on a several-month outlook. Stock prices are reflecting earnings estimates that have nothing remotely like a recession in their calculus and so on. So that makes for a potentially messy situation. We could get further into the weeds in terms of the underlying options set up in that market and how that's been providing some real support for this market. The other day I talked about my 7 bullet points. I may talk briefly about an 8th one that I added that kind of helps explain this phenomenon to this point. But going forward, looking at the next few months, let's just say, it's fascinating to me, this narrative that's developed. You can almost call it a no landing narrative. I keep hearing that. And that means that the economy doesn't slow, right? And things just kind of calm down, and that inflation miraculously comes down to the Fed's 2% target, earnings rise in a good, strong economy, and we just kind of drift off into the future, continuing just to maybe slowly but surely melt higher and higher and higher in, let's say, U.S. equities. So our view is that if we don't get a slowdown in the economy and get unemployment a bit higher and the commensurate disinflationary forces that come with an economic slowdown, that there's virtually no chance that the Fed's going to see its 2% inflation target, other than maybe a blip here and there based on perhaps base effects or rapidly falling energy prices or that sort of thing. We really need a recession to see that inflation number come down to something below their 2% target. Our long-term structural view, however, is that once we work our way back out of recession, if indeed we fall into one, inflation is going to come right back, and we're going to settle into a range, maybe it's 3 to 5% for the long term going forward. We've talked about the new labor-friendly regime versus the old capital-friendly regime and what all that means. I've written volumes on it, talked about it here. So suffice to say that, again, the Fed's objective probably doesn't get met without a notable slowdown in the economy. If that's the right narrative, if our indicators do work and suggest that that's what we have in the offing, well, then corporate earnings are going to come down. Now, corporate earnings in your average recession come down in the neighborhood of 25%. Now, at a price-to-earnings ratio around 20 on the S&P 500, which is historically high, if that were to hold, right, you would get, a 25% decline in the price of stocks. I wrote about this morning. I borrowed it from one of BCA's analysts. In a mild recession, we might see a 15% decline in earnings. And that would bring stocks down 15% if the price to earnings multiple stayed where it is. As I said in my morning note, though, particularly with what I think is potentially under this market that could unwind in a hurry if we did get a sell-off and we broke down below some key levels, well then the multiple, meaning the price earnings multiple, can contract big time. In fact, this year's stock market phenomenon, the nice move that we've seen in the headline averages, cap-weighted averages, is multiple expansion, meaning is the price to earnings multiple going up. It's not about fundamentals. It's not about improved profits and that sort of thing. Certainly when we adjust for inflation, earnings have actually already come down. So then an unwinding of that incorrect pricing of stocks, I guess is what I'm alluding to, in a recessionary scenario, even in a mild recession, makes for worse than a 15% decline. We think that the potential is notably worse than that. We're also open to even this no landing narrative. I mean, we have to be open to all narratives. You know how markets work. It's just we need to crunch those and listen to the bulls and just try to get our heads around what they're thinking and why, and then just assess, do we agree with it? And or do we think that, while anything's possible, it would be way too risky to take on the kind of risk that we say had on from 2009 to 2019 in this kind of environment? And the answer right now continues to be no. We're not interested in being right and saying, hey, we told you the risk was there, therefore we were right, and the market rolled over. That's not what this is all about. And unfortunately, that's what you get in the media. If you watch CNBC, I don't recommend that you do that, but if you do, that's fine. You're going to see a lot of personalities come on, talk their book, meaning their thesis that they've published, where they're managing money and so forth. And I'm talking bulls and bears. It doesn't really matter. It's just we have to identify when people are data mining, meaning looking for the data that supports their thesis for whatever reason, right? Because the last thing in the world you want to do is find data that ultimately is faulty just because it makes you feel better about your analysis. Just know this, clients in particular who happen to be watching this video, that's just not how we're going to operate. We're always just going to do a very deep assessment of the risk-reward setup and invest, not invest, hedge, not hedge, what have you, accordingly. So let's just do this. So the S&P 500 daily chart is, I will say, I did talk about it being boring, but you see the blue candle just dipping below the very short-term trend line, part of this rising wedge pattern. That is just one day. We've seen lots of whipsaws. We could come barreling back tomorrow. A soft PCE inflation number tomorrow morning could be bullish for stocks, right? So having said that, that would be a short-term sell signal, particularly when it's coupled with a sell signal on the moving average convergence divergence. The relative strength index, just the textbook way this works, is when it gets above 70, a market is overbought. Right now, we have the breakdown, we have the bearish divergences and so forth, and looks a lot like the all-time high. Now, I mentioned the NASDAQ wanting to point something out, because if you look here, these were pretty compelling setups, right? There is a bearish divergency of a higher high, right there, slightly. A big-time bearish divergence with a sell signal on the MACD. You had a sell signal right here as well. You were overbought right here as well. And then here you had this bearish divergence. So what happened, right? You were very overbought, more so than you've been since the all-time peak, right? We're there big time now. And the market did roll over. You broke through this trend line, battled it for several days, and then kaboom, right? Well, right in here, this drop right here can be explained by the regional banking, and I'm going to call it a crisis for lack of a better term right here, right? And the Federal Reserve effectively jumped in and rescued that situation with about $400 billion getting thrown back onto its balance sheet while it's trying to reduce its balance sheet, right? But then the technicals really didn't improve. So then we went right back into a rising wedge pattern, had our bearish divergences, boom, another sell signal, and we just, barely went down. When was that? In April. What was happening in here? First quarter earnings, where AI, remember NVIDIA and so forth, suddenly became the buzzword, and we just had this monster ramp higher in the NASDAQ 100 index and in the S&P as well. So this market, where it looked like it was really seriously ready to roll over, at least technically speaking, ironically, something that could have absolutely killed it got rescued quickly. And I think a combination of then the AI craze plus the evidence that the Fed is going to step in if something in the financial sector cracks emboldened investors again. And I think a lot of bears, very bearish setup coming into 2023, those bears are still capitulating. I've written about that a few times of late. And of course, that's money coming into the market. The problem with that is if we get them all over to the bull side of the boat, just basically you get buyer exhaustion, then you get some bad news, and then finally we begin our next leg down. Well, look what's happening here, and it just did peak below. This is a pretty good trend line right here. I mean, we've got multiple hits there, right? Today, it's hard to tell, closed just underneath it. Not enough really to do anything with, in my view. However, you do have a sell signal here on the MACD. You're coming off of hugely overbought levels, hugely, in my view, certainly relative to this entire history of the bear market. And you do have a bearish divergence there as well. Again, tomorrow morning we're going to get some inflation data. This one, the NASDAQ 100, is very interest rate sensitive. We'll see how that goes, and I'm going to talk about that interest rate sensitivity within the context of today's action. So the dollar, this was the daily chart. Let me go to the 1 year chart first. Remember when we did our June equity market conditions study? We've been pretty spot on the dollar for a long time. We pretty much nailed it right here, said this was bullish for stocks, meaning weak dollar, strong stocks. That's what happened in the month of June. This is where our technicals completely failed, was in the month of July. So we were bullish the dollar coming in, so we said that was a headwind for stocks. Stocks have gone up in July. The dollar just utterly crashed. And then I would say on weak economic news, strong inflation numbers in other places, and the idea that U.S. interest rate advantage for the currency was going to wane as interest rates began to go up in other places, or the U.S. had to cut them faster. Well, since then, as you can see, for multiple days now, the dollar has ramped up quite notably right here, right? So that is a potential, again, headwind for stocks. You do have a buy signal right here, and you're coming off of very oversold levels. I will say this, however, this looks, it's a little long for a bear flag, but right about here is where it would look like a classic bear flag, but it's continuing to go higher, so maybe not. But that would actually suggest there's another leg lower in the dollar, and that on net would be bullish for things like stocks and commodities. Today's GDP number threw cold water all over the recession narrative. 2.4% was way better than expected. Jobless claims were way lower than expected. I'll talk about that probably in tomorrow's economic update. And let's talk about that GDP number and its effect on asset prices. So this is TLT. So think of this as inverse to interest rates. This is the ETF that tracks 20 plus year maturity treasury bonds. So when interest rates go up, the price of this goes down. Okay. So early in the morning, this morning, before the market opened, we got this fabulous GDP number, right? We could get into the weeds as to what components did well. Maybe I'll do that tomorrow. We'll see. But bonds reacted right away, and they just plummeted with that number, right? Recovered a little bit late in the day, but that made sense. Now, why did that make sense? Well, the day before was the Fed meeting, and really nothing happened. There was some volatility, but Jerome Powell, they raised it a quarter point. He just really was a kind of a blah meeting, and he's just dancing around every question, and basically data dependent. Same thing with the European Central Bank, Christine Lagarde, her press conference today. So the market's just kind of saying, you didn't really give us anything here. Other than you're going to continue to fight inflation and you're going to be data dependent. Well, that GDP number freaked out the bond market. Said, well, if GDP is at 2.4%, inflation ain't going nowhere and interest rates ain't going down. And so bonds sold off. If anything, interest rates are going up. How about gold, right? Just ETF that tracks gold very, very closely. GLD, big position for us in our core portfolio, by the way. So gold yesterday actually had a pretty nice day, and it's actually been doing pretty well of late, right? Last couple of days anyway. And actually the trend's been good. We've done well in our gold position this year. So gold is kind of believing what we think, right? And that is that the economy is going to weaken going forward. Well, look what happened, right? When that GDP number came out this morning. It just absolutely plummeted, and it stayed down, right? Really throughout the whole trading session. I mean, it bounced around, but it didn't, it closed, I think, below even the initial thrust lower. So either gold traders are, believing that this economy is a lot stronger than anybody thinks, or frankly, and this is how it works, traders in gold believe that traders in gold and other assets are basically going to buy into this economy's going to do well narrative. And again, that gets to our no place to go for equities, or perfect storm, if you will. If we have a slow economy, earnings go down, and I just did that math for you, what that means for stocks. If you have a strong economy, interest rates keep going up or stay at very restrictive levels, which is going to bring the economy down. But even before then, stocks are going to react negatively to this notion that inflation isn't going anywhere. Well, stocks didn't actually react to that right off the bat. And here's the NASDAQ 100, or the ETF that tracks it, right? It actually ramped to the moon, so to speak. But this was not because of the GDP number, frankly. This was because of Meta's earnings after hours, and it just pulled the index up with it. It's a big company, right? So, the GDP number came out, but the market continued to trade way higher. And we're sitting here looking at this thinking, wow, isn't that interesting? I get that earnings were good, better than expected, and so forth. Well, later in the day, much later in the day, this massive rally was faded like something you don't see very often. So traders jumped in and sold the heck out of tech stocks during the day. It's like a 2.25% plunge. So it's just like somebody woke up and said, this is just not a good scenario. What bonds are telling us and what gold is telling us is that inflation isn't going anywhere and interest rates are going to continue to go up. Similar look for the S&P. This is taking a while. I don't think I need to show you that, but basically the same action there. So we'll see how this plays out. Again, our base view is that the economy is about to suffer some weakness over the next several months. That's actually going to bring inflation concerns down. But one of the problems with the second half of the year is that the second half of the last year, we had very low month-over-month inflation numbers. So the base effects on the year-over-year number is going to be, not favorable to getting inflation down, right? The other thing, too, is that very good June inflation number, and that may be reflected in tomorrow's PCE inflation data. That reflected energy prices way higher June of last year versus June of this year. Well, since they bottomed, they've gone up notably. So we're going to have some energy pressure on inflation going forward. We're going to have base effects pressure on inflation going forward. So that may mitigate what we might normally see in terms of inflation coming off the boil in a weaker economy scenario. So how would you like to be weakening, but inflation staying sticky or stubborn, to where the Fed really isn't going to be able to do anything to jump in and rescue the economy, at least in the beginning stages of that? It's really one of those kind of catch-22 situations. You're kind of damned if it does and damned if it doesn't. But having said all that, stocks are pushing within a few percentage of their all-time highs. So that flies directly in the face of what I'm saying here and what I've been saying. But it also, I think, reflects, a lot of professional money that's been just really, really treated poorly this year by markets because they really thought there was another leg lower. And there's some career risk, and you're seeing this bullish narrative again. So I think you're seeing people chase stocks and push them higher. And at the same time, we're seeing some very interesting options action that, as I've explained in the past, really has dealers hedging their positions in a way that pushes stocks higher as well. That flips in an opposite kind of narrative, and that can exacerbate the downside like it's, I think, exacerbated the upside to this point. I'll say it again, I've been saying this a lot. Either the market's gonna do its thing, there's another leg lower, stocks are gonna get really cheap in that scenario. We're gonna wanna buy that, we're gonna wanna get into the more value-oriented, more commodity-oriented things that we really wanna own for the next few years. Or our forecast is gonna clear and conditions are gonna be conducive to taking on that additional volatility. We're okay either way. The bottom line is we want to take on more exposure when the risk-reward setup says it's a good time to do that. Thank you, as always, for staying with that long one. Really appreciate it. Talk to you either tomorrow or Sunday about the economy. Take care. Bye-bye.